Analysis of Korea's quantitative easing, QE possibility and impact. 1. Prerequisites for QE. Severe economic crisis. Quantitative easing (QE) in Korea would likely be considered only after catastrophic shocks to domestic asset markets, such as stocks and real estate. As an unconventional monetary policy, QE is a last resort when traditional tools like interest rate cuts are exhausted. It acts as an extreme prescription to stabilize markets and restore confidence during deep recessions or financial crises. The mere discussion of QE signals a significant deterioration in economic conditions, with markets already in turmoil. 2. Purpose and effects on asset prices. QE involves central banks injecting liquidity by purchasing assets, primarily government bonds, to stimulate the economy. This liquidity is expected to flow into the financial system, potentially increasing asset prices by boosting investor confidence and risk appetite. Central bank intervention can improve market sentiment, encouraging investment in riskier assets. However, if asset prices do not rise despite QE, it may indicate a liquidity trap or pervasive economic fear among investors. In such cases, central banks might escalate to qualitative easing, expanding purchases to include corporate bonds or equities, or adopt more aggressive measures to stimulate asset prices and restore confidence. The success of QE is often measured by its ability to stabilize and elevate asset prices, a critical indicator of economic recovery. 3. Investor challenges. The pie-in-the-sky dilemma. A significant issue arises when QE is implemented. Most investors may lack the capacity to capitalize on it. In a crisis, portfolios are often already depleted due to market declines, leaving few with sufficient cash reserves or the confidence to invest. While QE theoretically creates buying opportunities at depressed prices, only those who secured liquidity before the crisis or have the resources to act decisively during turmoil are likely to benefit. This concentrates QE's advantages among a small group of well-prepared or bold investors, limiting its broader impact. 4. Korea's core constraint. Exchange rates and U.S. influence. For non-reserve currency nations like Korea, QE is a double-edged sword. Injecting massive liquidity in one risks currency depreciation, leading to a surge in exchange rates. This could trigger severe side effects, such as imported inflation and capital outflows, destabilizing the economy. Korea's past, including the IMF crisis, underscores the dangers of sharp exchange rate fluctuations. Implementing QE in Korea would likely require coordination with or tacit approval from the U.S. Federal Reserve, the linchpin of the global dollar-based financial system. Since the 2008 global financial crisis, the U.S. has used tools like currency swap lines to stabilize allied economies and prevent systemic contagion. These swaps ensure exchange rate stability, but they also limit Korea's monetary policy autonomy. As acknowledged by the Bank of Korea, the country's financial system operates partly under the influence of U.S. monetary policy, making unilateral QE challenging. Historical context. Bretton Woods and dollar swaps. The Bretton Woods system, 1944 to 1971, provided global financial stability through dollar-pegged exchange rates, with the U.S. as the world's financial anchor. After its collapse, floating exchange rates and financial liberalization granted countries greater policy autonomy but increased vulnerability to foreign exchange crises. The 2008 crisis highlighted the need for coordinated central bank actions. U.S.-provided dollar swap lines have since acted as a global financial safety net, mitigating individual country crises while reinforcing U.S. influence over global monetary policy. For Korea, these dynamics constrain QE's feasibility, as exchange rate stability remains paramount. 5. Additional considerations for Korea. Korea's government bond market is smaller than those of the US or Japan, which could limit the effectiveness of large-scale bond purchases and risk market distortions. Effective QE might necessitate increased bond issuance through proactive fiscal policy. In real estate, excessive liquidity could fuel asset price bubbles and exacerbate inequality, though a crisis severe enough for QE would likely involve deeply depressed property markets, shifting policy focus to recovery. Moreover, Korea's export-driven economy is highly sensitive to global trade dynamics. QE-induced currency depreciation could harm export competitiveness if not carefully managed, further complicating implementation. The Bank of Korea would need to balance domestic stimulus with external stability, a delicate task given global interconnections. Conclusion: a cautious approach and need for preparation. While QE remains a theoretical option for Korea, its implementation faces significant hurdles, particularly around exchange rate stability and U.S. coordination. QE would likely be a response to a severe economic crisis, making it a challenging policy to view optimistically. Predicting when or if QE might occur is difficult, but preparation is essential. If QE is enacted, markets will likely have already endured substantial disruption. Investors should prioritize understanding and preparing for the chaos that precedes QE rather than banking on asset price gains from the policy itself. The focus should be on resilience in the face of market turmoil, not speculative hopes for QE-driven recovery.